Hey everyone, and welcome to the Flow Tao Salon. Let's just jump right into it. Today, we've got an exclusive explainer decoding a massive data drop that operators, investors, and honestly, anyone watching the industry has been anxiously waiting for. We're talking about the Q2 2026 China hotel market sentiment. We're going to take all this high-level hospitality data and really break it down piece by piece so you can see exactly where the market is heading over the next quarter. If you want to understand the true, boots-on-the-ground pulse of China's hospitality sector right now, well, you are definitely in the right place. But before we throw a bunch of numbers at you, let's establish exactly where this intelligence is coming from. The insights we're unpacking today are drawn directly from the 44th China Hotel Market Sentiment Report. So no guesswork here. This is rigorous, comprehensive research conducted jointly by the heavyweights, Horwath HTL, HODATA, and CHAT. And what's really great is that this survey was fielded super recently, right between March 17th and April 5th, 2026. That means we're looking at the absolute freshest, up-to-the-minute data available for the second quarter. It's a vital snapshot of an industry that is very much in transition. So here's our roadmap for today's explainer. First, survey background and index definition. 2, overall market expectation. 3, Tier 1 city resilience. 4, core market drivers. And finally, 5, 3 key findings. Okay, let's kick things off with Section 1, survey background and index definition. So who actually took this survey? After filtering everything, the researchers were left with 751 highly valid samples spanning across 31 provinces and municipalities. Now, here's the kicker you really need to keep in mind. An overwhelming 93% of this data comes straight from the luxury and premium sectors. Specifically, we're talking 64% from 5-star and 29% from 4-star properties. As we go through this, remember that you are hearing the collective voice of the biggest, most high-impact players in the market. And since luxury and premium hotels are usually the canary in the coal mine, the very first to feel macroeconomic shifts in travel budgets, this gives us an incredible, direct read on high-end consumer confidence and corporate travel willingness. It essentially sets the tone for the whole ecosystem. Let's also do a quick math check so we're all on the same page about how this sentiment is actually scored. The researchers use a model that operates on a scale from -150 to +150. Pretty straightforward, right? A score of exactly 0 means the market is totally neutral. They aren't expecting a boom, but they aren't bracing for a crash either. If it drifts down toward -150, things are getting extremely pessimistic regarding revenues and occupancy. If it climbs up toward +150, the market is hyped up and expecting massive growth. Keep this scale in the back of your mind. It's the lens we're going to use to weigh all the upcoming numbers. Moving right along to Section 2, overall market expectation. All right, the nationwide comprehensive sentiment index for Q2 2026 sits at -9. So what does that tell us? Overall, the nation's hoteliers are feeling, well, slightly pessimistic. It's a very cautious neutrality that's just tipping into the red. Functionally, for a hotel manager on a daily basis, a -9 means budgets are tight. It means you might be looking at temporary hiring freezes, or ownership is taking a magnifying glass to any capital expenditure for renovations. It's an environment where you are terrified to raise room rates because you don't want to lose your volume. But as you'll see in a second, a single national average can be incredibly deceptive. It hides some wild dynamics happening just under the surface. Because look what happens when we break that -9 down geographically, the story totally splinters. Down in South China, they're practically neutral at a -2. The East and Northeast are pretty stable too, just keeping their heads below the waterline. But man, you look at the Central, Southwest, and Northwest regions, and sentiment just drops off a cliff, hitting rock bottom at -28 in the Northwest. Hoteliers out there are bracing for a much harsher reality than the guys on the Southern coast. Running a hotel in a -2 market is a totally different ballgame than a -28 market. In the Northwest, it's all about aggressive cost-cutting and survival. In the South, they're just proceeding with caution. So recovery is definitely not uniform. Let's drill down a bit deeper into Section 3, Tier 1 city resilience. To really grasp the Tier 1 market, you have to understand that these cities are playing completely different games right now. There's this stark contrast between your sun-soaked, booming leisure destinations and your bustling, slowly grinding corporate business hubs. The path to getting a positive score depends entirely on which identity your city leans into, because filling rooms with families on vacation requires a totally different playbook than attracting corporate accounts and massive conferences. Take Sanya, for example. It is absolutely thriving with a massive positive index of 38. That is heavily driven by peak season leisure. People are going on vacation, and pricing power there is rock solid. Contrast that with Beijing, which is sitting at a -10. Now, I know -10 sounds bad, but actually, scratch that, it's incredibly good news for them because it represents a 15-point surge from the previous quarter. It's the biggest leap forward on the board. Why? Mega events, specifically the Beijing International Auto Show. When an event like that rolls into town, tens of thousands of people suddenly need rooms, flipping occupancy from dead to fully booked in a heartbeat. It just shows how one major catalyst can totally revive a corporate hub. And then you've got this fascinating success story in Shenzhen. They've officially crossed into the green with an overall index of 6. What's the secret sauce there? A super robust occupancy index of 22. Hoteliers in Shenzhen are feeling great about demand because they're riding the bleisure wave, that beautiful blending of business and leisure. Corporate travelers are extending their weekday trips right through the weekend, and it's being topped off by regional tourists making short weekend hops. They're basically attacking both the weekday corporate lull and the weekend leisure spike at the same time, pushing their expectations comfortably into positive territory. Which brings us to Section 4, core market drivers. What's actually pulling the levers behind the scenes? Well, there's basically a violent tug-of-war happening across the sector right now. Pulling upward, you've got about 44% of operators pointing to local tourism development trends as a huge positive. Hoteliers genuinely believe local government campaigns and domestic travel pushes are working. But pulling aggressively in the opposite direction is this deep systemic fear of new hotel supply. Sure, local tourism is growing, but the sheer volume of brand new hotel rooms opening up is causing massive dilution. It's turning into a knife fight for market share. Think about it. You might have 10% more tourists entering your city, but if your competitive set just added 20% more rooms, you are going to be battling tooth and nail just to maintain your current baseline. All right, let's bring it all together in Section 5. 3 key findings. If you take absolutely nothing else away from this explainer, you need to remember these 3 things. Number 1, yes, nationwide sentiment is a cautious -9, but the sub-index for occupancy expectations is actually a positive 12, meaning hoteliers know the guests are coming. Their anxiety is entirely centered around pricing power and actual revenue. Number 2, recovery is hyper-localized. Core markets are finding success through totally distinct paths. You're either riding a pure leisure wave like Sanya, or you're banking on the return of mega exhibitions like Beijing. And number 3, the ultimate battleground for Q2 is maximizing those local tourism tailwinds while actively fighting off the dilution from new supply. The real strategic value here? Stop panicking over national averages. Start aggressively targeting localized pockets of demand, whether that's optimizing for bleisure or locking down event-driven corporate contracts. That is how you hold your pricing power. And that wraps up our analysis for today. In this industry, being an informed, hyper-focused operator is literally your ultimate competitive advantage. Keep a close eye on those regional divides, watch how new supply shifts the balance in your specific neighborhood, and keep leveraging this kind of data to stay 2 steps ahead. Before we sign off, I want you to ask yourself, is your property positioned to ride a localized wave right now, or are you about to get drowned by the incoming tide of new competitors? Really think about it. Thank you so much for joining us for the special Flow Salon Explainer, and I'll leave you with our final wish for your upcoming quarter. Tao Su Sha Long, Ma Niang Xing Long.